In the previous chapter, we did cash transactions, and in this chapter, we move on to credit transactions. So the first thing we need to look at is the different types of source documents. So these are the ones that we did for cash transactions, cash receipts, EFT receipts, EFT payments, and bank statements. And in this chapter, we're going to go through the following: sales invoice, purchase invoice, credit note, and statement of account. And that will just leave in the next chapter some odds and ends, some other sort of source documents that we need to process in memos, order forms, shipping and order confirmations, and delivery dockets. So let's get stuck into the source documents for credit transactions. And the first one we'll deal with is a sales invoice. And that is issued by the business, so that's our business, when it makes a credit sale of inventory to another entity. For example, a customer. The other entity agrees to pay the business cash in the future, for example, in 30 days. So that would be a sales invoice. There is also a purchase invoice, and that is, instead of being issued by our business, that is issued to our business when it makes a credit purchase of inventory from another entity, and we agree to pay that entity in the future, for example, 30 days. So in the real world, there's actually just invoices. We don't use the term sales invoices and purchase invoices. There's just invoices, and it just depends from what perspective it is, whether it's a sales invoice or a purchase invoice. So if we're the one selling on credit, that's going to be a sales invoice. If we're the one buying on credit, that will be a purchase invoice. We'll also need to deal with credit notes, and we'll issue those when goods previously bought or sold on credit are returned to the business who sold them by the customer. So the customer brings inventory back. And for our business, we will both issue and receive these from other entities. And then the last one is a statement of account, kind of like a bank statement. At the end of every month, you get a bank statement showing all your ins and outs with money. This doesn't show just that, it shows a bunch of other stuff, but it's basically a statement issued by the seller of the goods on credit to the customer who purchased those goods, and it shows all the transactions between the parties for the month. So it will show all the credit sales, all the credit purchases, all the cash receipts, all the cash payments, all the discounts, and all the returns. And again, the business will both issue and receive those. So just to summarize how all these documents will work with some diagrams, here's suppliers and here's our business. So when we purchase inventory on credit from suppliers, so for example, footy jumpers, we will get a purchase invoice. So that is issued to our business because we made a credit purchase of inventory. And when we sell those to customers, that'll be a credit sale, and the source document will be a sales invoice. So that's issued by our business when it makes a credit sale. However, there will be times when customers bring things back, and what we'll say is they could bring it back because it's faulty or the wrong size. And when they do that, that's going to be called a sales return, which we'll deal with in a future video. And the document that will get issued is a credit note, and that gives a credit to the customer off their account, and they don't have to pay us for the jumper that they returned. But our business will also return inventory to our suppliers, and we'll call those purchases returns. And when we do that, we'll send the jumper back, and the document we'll get is also a credit note. So it's the same document, whether it's a sales return or a purchase return. It just depends whether our business is the one returning the inventory or the one where a customer is returning it to us. And lastly, we need to deal with statements of accounts. So what happens is at the end of the month, the supplier will provide a list of transactions and what you owe us, and that's called a statement of account. And we can then go through that and make sure it matches our records. But because our business is also selling on credit, we're going to issue statements of accounts. So at the end of the month, we'll give these to customers saying, here's a list of transactions and what you owe us. And we'll need to use both of those to reconcile our accounts, both for the customers where we've sold things on credit, but also with our suppliers where we've purchased them on credit.